All right, so if you're a small business owner in Canada, I've got a question for you. Did you know there's a powerful tool out there that could save you a ton of money on health expenses? It's often misunderstood, but today we're going to change that. I'm talking about health spending accounts, or HSAs. In this explainer, we're going to break down exactly how they work, how much you can really save, and how you can get one set up the right way.
So let me ask you this. Think about the last time you had a dental bill or had to buy new glasses. Where did that money come from? If the answer is from your personal after-tax salary, well, you are literally leaving a significant amount of money on the table.
And here's why that's such a big deal. I call it the double hit of taxes. See, first, your corporation earns its profit, and bam, it pays corporate tax. Then it pays you a salary, and bam, you pay personal income tax on that. It's only with what's left over after being taxed twice that you can finally pay for your family's medical needs. Seriously, there has to be a better way.
And you know what? There is. Meet the health spending account. The absolute simplest way to think about this is like a special pot of pre-tax money. Your corporation gets to set aside before taxes just for you and your employees' personal health costs. It's a straight line and it's super tax efficient.
Now, if you go looking this up on the CRA website, you'll see they have a much fancier official name for it, a Private Health Services Plan, or a PHSP. And that official status, that's the real key that unlocks all the tax-saving magic we're about to get into. Don't worry, we're just going to keep calling it an HSA, but it's good to know the official lingo.
So how does this thing actually save you money? Is it some complicated tax scheme? Nope. It's not magic, but it is pretty darn close. It's all about changing the flow of your money and just cutting out the unnecessary tax steps along the way.
This slide just lays it all out perfectly. Okay, look at the left. That's the old, painful way. Your company profit gets taxed, your salary gets taxed, and only then do you get to pay your bill with what's left. Now look at the right side. With an HSA, your company earns profit and puts pre-tax money directly into the HSA. From there, you pay the expense. It's shorter, it's way more direct, and here's the kicker, that contribution is a 100% tax-deductible business expense for your company. Game changer.
So, who can get in on this awesome deal? Well, basically any incorporated business in Canada. And this is absolutely brilliant for solopreneurs. You can set one up even if it's just you, the single shareholder employee. It's perfect. Now, for unincorporated businesses, there's a small catch. The plan has to cover at least one arm's-length employee. That just means someone who isn't you or a direct family member.
All right, theory is great, but let's see what this actually looks like with real numbers. Let's crunch some numbers and walk through a real-world scenario so you can see the concrete financial benefit for yourself.
Okay. Check this out. Let's imagine an owner with a $100,000 salary who has $3,000 in medical bills for the year. To pay that personally, you can see in that first column, the corporation has to shell out over $4,300 in salary just to cover the bill and all the taxes. The final net cost to you is $3,738. Now, look at the HSA column. Even after you factor in some small admin fees, the total net cost is just over $3,100.
That's a difference of over $600, a 16% savings on the exact same medical bills, just by changing how you pay for them. That is real money, right back in your pocket.
And here's the best part. This isn't some one-off thing. The benefit actually scales up. As your income grows and as your family's medical expenses grow, the savings from using an HSA just get bigger and bigger. I mean, look at this chart. At a $150,000 salary with $5,000 in expenses, the savings jump to almost $2,500. The higher your tax bracket, the more powerful this tool becomes.
Now, because this is such an effective tax tool, it is absolutely essential that you use it correctly and stay on the right side of the Canada Revenue Agency. So, let's talk about the rules of the road. And look, the CRA has been very clear about this. HSAs are a legitimate health benefit. They are not a loophole or some sneaky scheme to disguise personal spending as a business expense. The whole point, the whole structure, is designed to provide health coverage, and you gotta treat it that way. So what does that mean in practice? Well, first, your plan has to follow those official PHSP rules. Second, the coverage limits you set have to be reasonable. We'll talk more about that in a sec. And this is crucial. The CRA has to see it as a benefit for an employee, not just a perk for being a shareholder. And if you've got a team, a good chunk of them should be included in the plan too.
So what in the world is reasonable? Well, the CRA doesn't give a hard and fast number,
But a really solid industry rule of thumb is to set your annual HSA limit somewhere between 10 to 15% of what a regular, fairly paid employee in that same job would make. This really helps prove that it's a legitimate part of their compensation package.
And hey, a quick but super important note for all the businesses in Ontario. Provincial sales tax, or RST, and premium tax, or PPT, they both apply to your HSA claims and fees. If your provider isn't handling this for you, that responsibility and any penalties falls right on your business. So make sure you're with a reputable administrator who manages all that for you automatically.
Okay, you're convinced. You see the savings, you get the rules. So let's talk about the path forward. How do you get started? And even better, how do you supercharge your HSA to make it even more powerful? Getting started is actually way more straightforward than you might think. Honestly, the most critical step is picking a good administrator who's going to make sure you stay compliant. After that, it's really just a matter of setting your annual limits, working out the plan details with them, and then, of course, sharing the great news about this awesome new benefit with your team.
You know, a standard HSA is fantastic for all the predictable costs, dental checkups, new glasses, physio. But it does have one potential weakness. What happens if there's a major catastrophic health event? The costs could blow right past your annual HSA limit. And this is where we get to the supercharging part. For a tiny cost, we're talking about $10 a month, you can add a powerful insurance component that acts as a safety net for those huge, unexpected events. And just look at what you get for that. We're talking about a $2 million lifetime maximum for travel insurance, and right here in Canada, up to $125,000 per year for catastrophic events, things like private nursing or emergency services. This protects your finances from the kind of health crisis a basic HSA just isn't built to handle on its own.
So let's put it all together side by side. On one hand, you've got traditional insurance which can easily cost over $150 a month, often with pretty limited day-to-day coverage. On the other, you have the HSA plus this add-on. The cost? Just $10 a month plus the claims you actually make. This combination gives you total control. With pre-tax dollars, it includes massive catastrophic coverage, and it maximizes your tax savings. It is, without a doubt, the best of both worlds.
Now, to put a plan like this into action, you'll want to find a specialized provider. For example, companies like Red Helm Canada focus specifically on creating these smart, flexible plans for small businesses. Working with an expert like them just makes sure you get the structure right from day one. So let's end with this. As a business owner, you know the value of an asset, and your health and your family's health is the most important one you'll ever have. So the question is, are you using the most efficient, the most intelligent, and the most tax-effective tools you can to protect it? An HSA, especially a supercharged one, might just be the answer you've been looking for.